If you are retired or approaching retirement, the next few months are your best window to control how your retirement income is taxed for 2025. The IRS rules are calendar driven, require distribution, conversion timing, and charitable reaction. All hinge on what you do by December 31st. This video is designed for retirees and pre-retirees who want to lower their taxable income, reduce Medicare premium, and make the most of charitable giving before the year ends. We're breaking this into 4 parts so you can follow step by step. Part 1 cover required minimum distribution. Part 2 cover Roth conversion. Part 3 cover qualified charitable distribution. And Part 4 walk through your year-end checklist and bonus tax moves. So let's start with Part 1, which is required minimum distribution, often called RMD. So if you turn 73 this year or earlier, you must take your RMD by December 31st to avoid penalties. The IRS penalty for missing it is 25% of the amount not withdrawn, reduced by 10% if you correct it quickly. If it's your first RMD year, you can delay your first distribution until April 1st of the next year. But that means you will take 2 RMD in 2026, often triggering higher taxes and Medicare premiums. For most people, steady income sees a spike. Your RMD includes all your traditional IRAs, SEP IRAs, and simple IRAs. You can calculate each one separately, then take the total from one or multiple IRAs. But remember, employer plans like 401ks and 403bs cannot be combined with your IRAs. They are separate, and here a new rule worth remembering. Designated Roth accounts in employer plans no longer have lifetime RMDs starting in 2024. Both IRAs never had them in the first place, like Roth IRA. So let's make this concrete. So Marjorie from Kailua turned 73 in March. She had 2 IRAs, one at Fidelity and one at Vanguard. Her total RMD for 2025 is about $39,000. So rather than taking money from both custodians, we arranged for the entire RMD to come from Vanguard. So she submitted the paperwork in early December, which allowed enough time for processing before year end. So no last minute stress, no penalty, no surprises in January. Here how you can do this step by step. So step 1, you want to consider checking your December 31st, 2024 balances for all IRAs and qualified accounts. So if you are in the next tax year, like 25, do that. And then step 2, use the IRS Uniform Lifetime Table HA73. The factor is 26.5. So you want to divide each account balance by that factor. Step 4, add them all together to get your total IRA RMD. Step 5, schedule your withdrawal with your custodian so it's fully processed before December 31st. Now before we move to part 2, let's recap what we just covered. So you now know who must take RMDs, which accounts they apply to, and the deadlines, and how to calculate them. So getting this part right sets the foundation for everything else we will cover next, because both Roth conversion and charitable strategies depending on knowing your RMD number first. Let's move on to part 2 to talk about Roth conversion, which is where strategy meets opportunity. So a Roth conversion means moving money from a traditional IRA or 401k into a Roth IRA and paying the tax this year so that all future growth and withdrawal can be tax-free. So in 2025, the tax brackets under the Big Beautiful Tax Bill remain stable. That give you clear targets. You want to fill your bracket, don't spill over it. Meaning, say, for example, you're at the 22% tax bracket. You want to do just enough the conversion for a Roth that you still stay in that bracket. You don't jump to the next bracket, right? Unless you feel like the next bracket is still way below what your retirement bracket would be. when you actually have to take a big chunk of RMD. So why is it powerful? Because you are in control when to pay the tax, not letting the IRS decide for you later through RMD. So let's walk through how to do this. So for step one, you want to estimate your total taxable income for 2025, like pension, wages, social security, dividend, RMD, everything. Step two, identify the top of the tax bracket you want to fill. For married couple, the 24% bracket top at about roughly $394,600 this year. Step three, subtract your current projected taxable income. So the difference is your headroom. Step four, convert up to that amount from your IRA to your Roth. Step five, pay the taxes from a separate checking or brokerage account, never from the conversion itself. Step six, execute the conversion with your custodian before December 31st. Here's an example. So Ben and Anna from Austin had $250,000 of projected taxable income for 2025. So after modeling that, we found that they could convert up to 140,000 more and still stay in the 24% bracket. So they convert 85,000 this December, leaving room for investment income later in the tax year. So they pay taxes from their brokerage accounts, not from the IRA. So their full 85,000 keep compounding tax-free. Now, a few key guardrails for you. If you're already subject to RMD, you must take your RMD first. You cannot convert RMD dollars. Make sure to keep transaction confirmation and 1099-Rs for your CPA, and consider splitting conversion across multiple years, like 25, 26, 27, to smooth out the tax costs and avoid Medicare premium surcharge. So let's take a short pause and connect what we have learned so far. So in part one, we handle what the IRS requires, your RMD. Part two, we give you voluntary Roth conversion. Now we move to part three, Qualified Charitable Distributions, or QCDs. So this part is for retirees who already give to charity and want to make their gift tax smart. So QCD allow you to send up to $108,000 per person in 2025 directly from your IRA to qualified public charity once you are age 70 and a half or older. The amount counts toward your RMD, but is excluded from your taxable income. Why does this matter? So lower adjusted gross income means lower taxes on your social security, a better chance of avoiding Medicare IRMAA surcharges, and sometimes eligible for credit that phase out at higher income levels. So let's go step by step. Step one, choose the charity and confirm it's eligible for direct IRA gifts. Step two, request a check from your custodial payable to the charity, not to you. Step three, have the custodian mail it directly to the charity or to you for forwarding. Step four, make sure the funds clear before December 31st. Step five, keep the charity receipt and the custodian's confirmation. And here how it looks in practice. So Khalil and Malia from Honolulu, both 73, each with about 1 million in IRAs. So their total RMDs came in about 76,000. So they directed 20,000 each via QCD to two local nonprofits. So 40,000 total, reducing their taxable income by that amount. Then they converted 80,000 more to a Roth to fill the 24% bracket. They meet their RMDs, gave to causes they cared about, and lock in tax-free growth for future years, all before December 31st. So remember, QCDs only work from IRAs, not from 401k, and you can't double dip by also claiming a charitable deduction. So the benefit is already built into the exclusion from income. So we have covered three core moves so far, so RMD, Roth conversion, and qualified charitable deductions. So let's move into part four, your year-end checklist and bonus tax tips. So here's your year-end checklist. Number one, you want to confirm all RMDs amount for 2025 and make sure distribution are completed, not just requested. Number two, if you are charitably inclined, decide how much of your RMD to elect through a qualified charitable distribution. Number three, run a year-end projection to calculate your Roth conversion headroom. Number four, execute conversions, distribution, and QCDs early enough for processing before December 31st. Number five, review how your adjusted gross income affects your Medicare and Social Security threshold for 2027 premiums. Number six, if you underpay estimated tax this year, ask your custodian to withhold taxes from your December RMD. So those withholding are treated and paid evenly throughout the year, avoiding penalties. Number seven, organize confirmations, charity letters, and 1099-R forms for your CPA. Now let's make this practical with bonus tax strategies that can elevate your retirement planning. So bonus tip number one, the off-market RMD strategy. If markets are volatile, take your RMD from cash or bond heavy holding to avoid selling appreciated equity at the wrong time. Bonus tip two, the Roth ladder. So instead of one big conversion, create 3 to 5 years ladder, converting a portion each year. To spread the tax cost, manage IRMAA threshold, and provide flexibility. Bonus tip three, so spousal bracket planning. If one spouse is likely to survive the other, consider larger conversion while you still find joys to reduce future single filer tax exposure. Bonus tip four, Social Security coordination. So you qualify charitable distribution to keep provisional income lower, minimizing taxation of Social Security benefits. Bonus tip five, documentation discipline. For every qualified charitable distribution, retain the acknowledgement letter from the charity and make sure your tax preparer properly report the exclusion on your 1040. For conversion, label each transfer Roth conversion 2025 and keep custodian letters together. Bonus tax tip number six, charitable split gifts. If you are philanthropic and want lifetime income, explore the one-time qualified charitable distribution election up to $53,000 to fund a charitable gift annuity. Bonus tip seven, investment alignment. After you convert, revisit your asset placement. Grow assets belong to Roth accounts for maximum long-term benefit. Income generate asset can stay in traditional account where the income is deferred. Let's look at tip number eight. You want to consolidate orphan accounts. If you still have small 401k from old jobs, consider rolling them into one IRA to simplify RMD tracking. Let's bring it all together with one final story. So Erin and Tashi in Perth City, both age 73 and have 2.2 million in retirement accounts. Step one, we calculate their combined RMD at 83,000. Step two, they use 45,000 in qualified charitable distributions to support their church and a local scholarship fund, keeping their AGI lower. Step three, they converted 90,000 more to Roth to fill their 24% bracket. Step four, they withheld 8,000 in taxes from their final RMD to cover underpaid estimates. Step five, they store every receipt and confirmation in their year-end binder for their CPA. In mid-December, everything was done. Their 2025 taxes were predictable, and their Roth balance began compounding tax-free heading into 2026. Now, before we wrap up, remember that these moves only work when they time correctly. So the cutoff is December 31st. Once the clock strikes midnight, your RMD and conversion opportunity for 2025 disappears. If you found this breakdown helpful, check out our Pro Deduction store on Etsy for ready-to-use retirement and tax planning spreadsheets, RMD trackers, Roth conversion planners, and charitable giving logs. For deeper strategy courses and workshops, you can visit accesswithinstitute.com where we teach retirees and high-income earners how to build smarter tax plan with confidence. You got about 60 days left in 2025. Use them wisely. Make your distribution conversions and donation now so you can lock in today's favorable tax rate and keep more of your retirement income working for you. Thank you for watching. I'm Mia. I will see you at the next update.